Market crashes have a way of revealing truths that bull markets allow us to ignore. When prices rise steadily, confidence grows easily. Risk feels abstract, mistakes feel temporary. But when markets fall sharply, the emotional cost becomes real. Fear replaces optimism, certainty disappears. And suddenly the question is no longer how much you can make, but what you can safely keep. If markets crash in 2026, the real damage will not come from falling prices alone. It will come from panic, forced decisions, and strategies that were never designed for stress. Most people do not fail because they lack information. They fail because their plans depend on conditions that no longer exist once volatility arrives. This is why it matters to think carefully in advance about which assets you would truly trust during a market collapse. Not which assets look impressive on a chart, not which ones have performed best in recent years, but which ones can hold their role when confidence breaks down and headlines turn hostile. The asset I would trust in a market crash is not exciting. It does not promise protection from every loss. It does not move quickly, and it does not make for dramatic stories. But it has one advantage that matters more than anything else during periods of instability. It is designed to survive uncertainty rather than depend on optimism. Before naming it, it is worth understanding why most popular assets fail psychologically during crashes, even when they make sense on paper. When markets decline, investors tend to discover whether their strategy was built on conviction or convenience. Many portfolios look diversified in calm conditions but reveal hidden fragility under pressure. Assets that seemed independent begin moving together. Correlations rise, liquidity disappears, and strategies that rely on precise timing suddenly become liabilities. A market crash does not only test returns, it tests temperament. During downturns, information overload becomes a problem rather than a solution. Every headline feels urgent. Every forecast demands attention. Investors who believe they were long-term thinkers suddenly feel compelled to act. The desire to do something becomes stronger than the discipline to do nothing. This is where the difference between owning an asset and trusting an asset becomes clear. Trust is not about performance in ideal conditions. It is about behavior in difficult ones. It is about whether an asset allows you to remain rational when prices fall and narratives collapse. Many investors assume that intelligence or experience will protect them in a crisis. But crashes are not academic exercises, they are emotional environments. They challenge identity, patience, and self-belief. I learned this lesson slowly. Earlier in my investing life, I focused heavily on optimization, better ideas, better signals, better timing. I believed that preparation meant prediction. If I could anticipate the next move, I could avoid the worst outcomes. Over time, I realized that prediction is a fragile foundation for confidence. When predictions fail, conviction often collapses with them. What matters more than prediction is resilience. Resilience comes from owning assets that do not demand constant validation, assets that do not require you to defend them daily, assets that can endure periods of neglect, doubt, and pessimism without breaking their purpose. In a crash, you are not competing against other investors. You are negotiating with your own emotions. Fear of loss, fear of regret, fear of looking foolish for not acting sooner. Most assets intensify these emotions. Highly speculative assets magnify volatility. Growth-dependent assets amplify uncertainty. Leverage accelerates consequences. Even assets with strong long-term potential can become psychological burdens if their short-term behavior is extreme. When prices move violently, logic often arrives too late. This is why the asset I would trust during a market crash is one that minimizes decision-making rather than maximizes opportunity, one that reduces the number of judgments required when clarity is scarce. That asset is ownership in broad, productive, diversified equity through low-cost total market index funds, not because they avoid losses. They do not because they are immune to crashes. They are not. But because they are structurally aligned with how markets recover and how human behavior fails. A total market index fund does not rely on identifying winners. It does not depend on forecasting cycles. It does not require constant adjustment. It owns productive assets collectively rather than selectively. In a crash, this matters. When individual companies fail, others adapt. When industries decline, new ones emerge. When leadership changes, innovation continues. A broad index absorbs this process automatically. It does not need you to be right about which company survives or which trend dominates. It allows you to participate in recovery without needing to predict its shape. During a market crash, the greatest risk is rarely the temporary loss of capital. That is obvious, measurable, and recoverable over time. The real danger is far subtler, the loss of confidence. Confidence is what allows investors to stick to their plans when uncertainty peaks. Once confidence is shaken, even the most rational strategies are abandoned at precisely the wrong moment. Investors sell low, wait too long to re-enter, and miss the compounding that follows the market's natural recovery. The financial damage is not in the drop itself, it is in the reaction to it. An asset you can trust is one you can hold without constantly questioning yourself. It is an asset that allows you to remain steady, even when headlines scream. Index funds are one of the few assets designed to meet this standard. Their strength lies not in excitement or clever timing, but in consistency. They represent the market as a whole, and they reward patience, not judgment. You do not need to guess the next hot sector, anticipate a short-term trend, or defend your thesis to anyone. The simplicity of index ownership is underrated, particularly during crises. Narrative simplicity is a subtle but powerful advantage. In times of market stress, complexity becomes overwhelming. Individual stocks, leveraged positions, or concentrated bets demand constant attention. Each drop prompts a question: is this temporary? Is this permanent? Should I act? Index funds remove much of that friction. The story does not change every week. You are not betting on a single outcome or defending a volatile theme. You are simply owning the long-term productive capacity of the market. That ownership allows you to participate in growth while avoiding emotional overreactions. This simplicity also supports better decision-making. When markets are volatile, the urge to intervene is strongest. Investors feel pressure to react, to prove skill, or to control outcomes. That pressure can lead to mistakes, selling after declines, reallocating into riskier bets, or attempting to time recovery. Index ownership provides a natural guardrail against these impulses. By design, it encourages endurance. You can continue contributing, compounding, and holding without distraction. You avoid turning temporary noise into permanent losses. Moreover, simplicity nurtures confidence. Confidence is not built in moments of excitement or success. It is built quietly over time through repeated experience of staying the course. When you hold an asset that is designed to endure, you learn that markets recover, that temporary losses are normal, and that long-term growth is achievable without constant vigilance. That lesson internalized becomes far more valuable than any short-term gain or clever trade. In the end, the greatest gift of an index fund is peace of mind. It allows investors to focus on what truly matters: long-term planning, disciplined contributions, and calm decision-making. The market will fluctuate, headlines will alarm, and uncertainty will persist. But owning an asset that is simple, broad, and enduring ensures that you can remain invested, maintain confidence, and ultimately participate fully in the growth that follows recovery. Many investors underestimate how much stress complexity adds during downturns. Portfolios with multiple strategies, overlapping bets, or frequent tactical changes demand attention precisely when attention is most costly. In contrast, a simple structure offers psychological relief. It creates space for patience. Crashes compress time emotionally. Days feel like months. Losses feel permanent. Under these conditions, the ability to remain inactive becomes a competitive advantage. Index ownership supports inactivity. It does not demand reaction. It does not tempt frequent intervention. Its very design encourages restraint. This is not about blind faith in markets. It is about acknowledging historical patterns without romanticizing them. Markets have crashed before. They will crash again. This is not speculation. It is history. Crashes are an inevitable feature of financial markets, not an aberration. They remind investors that volatility is not a problem to eliminate, but a reality to manage. Recovery has never been immediate. Sharp declines test patience, discipline, and temperament. But over long periods, diversified ownership in productive enterprises has been rewarded consistently. Not because outcomes are guaranteed, but because human progress persists despite disruption. People continue to work, innovate, produce, and consume. Companies continue to create value. The economy continues to advance. Investors who participate in this ongoing process, rather than chasing short-term trends, have historically been compensated over decades. A crash in 2026, should it occur, would not signify the end of economic activity. It would represent a repricing of expectations. Markets are simply the aggregation of what participants believe is fair value today. When fear dominates, prices fall. When optimism returns, they rise. But the underlying process, the production of goods, the delivery of services, the creation of new ideas and technologies, remains unaffected by temporary panic. Ownership in that process retains meaning, even when the headlines suggest otherwise. Stocks do not create wealth by luck. They reflect participation in productive enterprises. This is the kind of ownership that endures because it is tied to tangible, measurable progress rather than sentiment. Contrast this with assets whose value depends entirely on continued enthusiasm. These are assets propped up by belief rather than productivity. Cryptocurrencies, speculative collectibles, or highly concentrated bets may rise rapidly in periods of optimism. But when confidence falters, these assets often fall the hardest. Their decline is magnified precisely because their foundation is psychological rather than economic. A productive business may lose value temporarily, but its underlying ability to generate goods, services, and cash flow remains intact. Enthusiasm-driven assets, on the other hand, lose value when belief evaporates because there is no underlying mechanism supporting recovery. The lesson is simple but rarely emphasized. Resilience comes from participation in productive enterprises, not narratives or hype. Diversification reduces the risk that a single failure destroys confidence. Holding broadly across industries, regions, and sectors ensures that even when some areas falter, others continue to function. Over time, this steadiness compounds. Investors who remain disciplined through crashes, focusing on the productive capacity of the economy rather than short-term sentiment, are the ones who benefit most from long-term growth. Ultimately, a crash is not an end. It is a test. It is a reminder that the foundation of wealth lies in productivity, not popularity. Assets tied to human ingenuity, enterprise, and progress endure because they reflect real economic activity. Those who understand this principle and who align their portfolios accordingly gain more than returns. They gain confidence, calm, and a reliable path through inevitable volatility. Crashes may test patience, but they cannot erase the value created by enduring productive work. That is why diversified ownership in productive enterprises remains the most trustworthy approach, even in the face of temporary turmoil. Trust requires durability. Another reason index funds earn trust in crashes is their transparency. You know what you own. You are not exposed to hidden leverage. You're not relying on opaque structures. Complexity tends to reveal unpleasant surprises during stress. Simplicity reveals fewer. This matters more than it seems. When uncertainty is high, clarity becomes a form of comfort. Knowing that your asset behaves exactly as expected, even when that behavior includes losses, reduces the urge to act impulsively. A crash does not require brilliance. It requires survival. Survival means avoiding catastrophic decisions, avoiding overreaction, avoiding concentration risk, avoiding the temptation to abandon discipline. The purpose of a trusted asset is not to eliminate discomfort. It is to make discomfort tolerable. Index ownership does not promise emotional ease. It will not make market volatility disappear or prevent losses from occurring. What it does offer, however, is emotional stability relative to more reactive strategies. When you hold a broad, diversified fund, downturns feel different. Losses are impersonal. They are the natural outcome of market fluctuations, not the result of a poor decision, a missed opportunity, or a failed prediction. You are not wrong. The market is simply volatile. That distinction matters more than most investors realize, particularly when emotions are high and headlines scream for immediate action. Emotional stability is not built overnight. It grows through repetition. Investors who have held diversified funds through prior downturns begin to recognize a pattern. Declines or temporary recoveries follow, and staying invested consistently yields long-term growth. This experience builds confidence not because losses never happen, but because losses eventually resolve themselves when patience is exercised. It is a quiet lesson. Volatility is not an enemy, and short-term pain does not dictate long-term outcomes. The value of index ownership is subtle. It does not make you feel clever or heroic. It does not promise rapid gains. Instead, it provides a foundation for disciplined investing. By reducing the emotional load of day-to-day market swings, it allows investors to focus on actions they can control, consistent contributions, long-term planning, and adherence to a strategy designed to endure. Over time, this calm approach compounds. Those who resist the urge to react, who accept that markets fluctuate and that recovery is inevitable, are the ones who benefit most from long-term investing. In the end, trust and discipline are inseparable. Diversified index ownership nurtures both. It teaches patience, reinforces calm, and reminds investors that over decades, steadiness almost always outperforms drama. That experience cannot be simulated. It must be lived. Market crashes have a way of exposing the difference between sound strategy and fragile conviction. When prices fall sharply, the damage is rarely limited to portfolios alone. It extends into behavior. Fear, hesitation, and the urge to act quickly can undo years of careful planning. Those who exit entirely during crashes often find that the hardest part is not selling, but re-entering. They wait for certainty that never arrives. Markets recover unevenly, headlines remain confusing, and before long, prices have moved beyond comfortable entry points. The result is long-term underparticipation, not because of poor intelligence, but because of emotional paralysis. A truly trusted asset is one that keeps an investor engaged without demanding precision. It does not require perfect timing, constant monitoring, or frequent judgment calls. Instead, it allows participation to continue through uncertainty. This quality becomes increasingly important later in life. As careers mature, income growth often slows. Time horizons shorten. The ability to recover from large mistakes diminishes. Risk tolerance does not fade because courage disappears, but because consequences grow heavier. Every decision carries more weight. A broad market index respects this reality. It prioritizes participation over prediction and resilience over excitement. Rather than betting on individual outcomes, it spreads exposure across the productive engine of the economy itself. This design reduces the psychological burden placed on the investor. There is no need to be right about which company will survive, which sector will rebound first, or which narrative will dominate the next cycle. The index absorbs uncertainty by design. Index funds also pair naturally with disciplined habits. Automated contributions remove the need to decide when to invest. Rebalancing schedules impose structure without emotional involvement. Infrequent reviews prevent overreaction to short-term noise. These systems are not exciting, but they are effective. They reduce emotional exposure precisely when volatility is highest, allowing behavior to remain steady while markets are not. During a crash, behavior matters more than asset selection. But asset selection strongly influences behavior. An asset that demands constant evaluation invites second guessing, pushes investors to interpret every headline, justify every dip, and anticipate every turning point. This environment increases the likelihood of error. By contrast, an asset that allows passivity lowers the chance of destructive action. It gives the investor permission to do nothing, which is often the most rational response. This is not an argument against all other assets. Bonds can stabilize income. Cash provides optionality and psychological comfort. Real assets may diversify risk. Each has a role depending on individual circumstances. But if forced to choose a single asset to trust during a crash, trust should mean the one least likely to provoke panic, overconfidence, or regret. Index funds excel in this role. They eliminate the pressure to be early because they acknowledge that timing will never be perfect. Crashes unfold unpredictably. Recoveries begin quietly. Index ownership accepts this reality and focuses instead on long-term exposure. It replaces the illusion of control with a system that works precisely because it does not depend on constant decision-making. In periods of extreme uncertainty, that quiet reliability is often the greatest advantage an investor can have. This acceptance is freeing. When you stop trying to be clever during chaos, you reduce self-inflicted harm. The market will do enough damage on its own. You do not need to help it. A crash also reveals another uncomfortable truth. Many investors believe they are long-term thinkers until they experience short-term pain. Only then does the difference become clear. Long-term thinking is not about time horizon alone. It is about emotional tolerance. An asset you trust helps bridge the gap between intention and behavior. It also reframes loss. Losses become temporary setbacks rather than verdicts on competence. This distinction preserves confidence, which is essential for staying invested. Confidence lost is expensive. It leads to avoidance. Avoidance leads to stagnation. Stagnation costs more than volatility over time. Index ownership helps maintain confidence because it does not rely on personal judgment for validation. You are not personally responsible for market movements. You are participating in a system larger than any individual decision. This humility is protective. It also aligns with realism. No one knows when markets will crash or recover. Acting as if you do is risky. Acting as if you do not encourages preparation. Preparation is different from prediction. Preparation in investing is not about predicting the next headline or outsmarting the market every day. It is about building structures that function under stress, systems that continue to work even when volatility rages and emotions flare. That is the essence of true resilience. Index funds exemplify this principle. They are not flashy. They are not exciting. And that, paradoxically, is their greatest strength. Excitement in investing often signals risk concentration. A stock skyrocketing overnight or a trendy sector capturing attention can make the heart race, but it rarely signals safety. Calm, on the other hand, often signals robustness. Index funds operate quietly in the background, reflecting the broad market rather than chasing individual opportunities. They are designed to endure shocks because they do not react impulsively to daily noise. They do not require constant judgment, and they do not rely on guesses about the next big thing. If markets crash in 2026, the headlines will scream. Analysts will make predictions, experts will share strong opinions, and media outlets will amplify fear. Every article, every news alert, and every social post will make it feel urgent to act. The temptation to react will be intense, but that is exactly the moment when restraint matters most. Insight alone is not enough. What matters is trust. Trust in your plan. Trust in your discipline. Trust in assets that are built to endure rather than impress. The goal is not to avoid losses entirely. No investor can achieve that. Losses are inevitable, and even the best prepared portfolios will experience drawdowns. The real danger lies in turning temporary losses into permanent damage, in panic selling, overreacting, or abandoning long-term strategies because fear feels urgent. Index fund ownership supports this goal quietly. It does not promise dramatic gains. It does not reward clever timing or clever thinking. Instead, it delivers steadiness, the kind of steady performance that compounds quietly over decades. Steadiness is often overlooked because it is invisible in the moment. It does not generate stories worth sharing at dinner parties or headlines that excite the market. Yet over time, this quiet consistency produces results that can surpass those who chase excitement, hop from sector to sector, or try to predict the next market swing. The difference is not skill or intelligence. The difference is discipline, patience, and trust in a strategy designed to endure. Consider the psychology of a market crash. Fear is contagious. Panic spreads faster than logic. Investors who are reactive may make decisions they later regret, locking in losses or taking unnecessary risks in an attempt to recover quickly. Those who remain invested in broad, diversified index funds, however, are protected from this emotional whiplash. They continue to participate in the market's long-term growth, while others are distracted by temporary chaos. They sleep better at night, knowing that their portfolio is designed to endure stress rather than chase glory. The value of index funds is subtle but profound. They teach a form of financial discipline that is easy to overlook until tested. They reward patience over cleverness, endurance over excitement, and consistency over impulsiveness. They demonstrate that in investing, the quiet, boring choices are often the most effective. When the market eventually recovers, as it always does, investors who maintain their strategy are likely to find that they have not only weathered the storm, but also outperformed those who tried to outmaneuver it. In the end, preparation in investing is about building trust. Trust in a plan that does not require constant monitoring, trust in assets that are resilient by design, and trust in your own ability to stay the course. Index funds are not exciting, but that is exactly why they work. They offer calm in the midst of chaos, stability in the face of uncertainty, and compounding that grows quietly over decades. When markets crash in 2026, it will not be clever predictions or dramatic trades that matter most. It will be trust. Trust in your plan, trust in your discipline, and trust in assets built to endure. That trust, exercised consistently, compounds over time, quietly creating wealth and security that survives the storms of life. That is the quiet truth most discussions overlook. When markets crash, the focus is often on fear, panic, and the search for the perfect protective asset. Yet the one asset I would trust in 2026 is not the one that promises to shield me from pain. It is the one that helps me endure it. Endurance matters because it allows recovery to work. No strategy, no prediction, no clever trade can replace the value of simply staying invested through stress. Recovery is where long-term returns are made. The temptation to react is strongest when headlines scream the loudest. Investors chase excitement, hoping to outsmart the market, only to find that impatience compounds losses faster than volatility ever could. True resilience comes from assets that do not demand constant attention, strategies that reward patience, and a mindset that prioritizes calm over noise. The quiet path may feel unremarkable in the moment, but over decades it produces results that dramatic moves rarely achieve. If you value clear thinking, long-term discipline, and lessons that prioritize steadiness over hype, subscribe now. This channel focuses on investing principles designed to last, not headlines designed to excite.